Hi everyone, this is Eric from Traders Helping Traders with this week's Tricks of the Trade. You know, I think one of the biggest obstacles facing traders is trend determination. Defining the market trend is very difficult because, quite honestly, it can be subject to a lot of different variables. Now, there's several ways that you can define market trend, but I tend to lean toward simpler things. Trading is difficult enough. So in my mind, the simpler you can make it, the better off you are. Now, there's two basic ways that I like to define market trend. And either of these will work. I think it's pretty much up to you to choose whichever one you want. One is not significantly better than the other. Let me show you both methods and then you can decide for yourself which you would choose to use. The first method is pure support and resistance. And what I mean by that is, as support and resistance traders, we're looking for a trending market to be making new support and resistance levels as the market continues in its direction. So for instance, here we have the soybean chart, and you can see that from this period here, from last March to the middle of June, the market was in an uptrend. Now that's obvious to look at. We can see that prices went higher. But how would you define that? Well, the simplest way is to look at where the market made support and resistance. And so long as the market continued to make higher highs and higher lows, it was in an uptrend. So let's take a look here. Here we have the market making a high. It comes down, makes a low, comes back, breaks the old high, which was back here, makes a new high. Comes down, makes a higher low. Comes back through, makes a higher high. Comes down, makes a higher low. Goes up, makes a higher high. Comes down, makes a higher low. And goes up and finally puts in the last of the higher highs. For this entire period up until this point in time at the middle of June, the market was in an uptrend. It wasn't until after that time that prices actually came down and made a new lower low. This low here is quite obviously lower than the old low here. That's our first sign that this trend is coming to an end. Now, sometimes there will be things that happen up here that give us early clues that the market might be struggling with trend. We can look at our momentum indicator like MACD or something to look for divergences, look for falling momentum. But just from a pure support and resistance standpoint, the market made a lower low, and then it came right back a few days later and it made a lower high. So now we obviously have moved from an uptrend situation into a downtrend. Now, even if you had missed this first lower low and lower high, which is easy to do because we don't know this is a lower high until the next day when it confirms, and it confirmed right here. It was about a week later that the market made a lower low and a new lower high. So this leg of the trade we could have certainly capitalized on. Now you'll notice that the market struggled somewhat here and it went sideways, but what's significant is that it failed to put in a new lower low. Every time the market came down here and hit the low, it could not go any lower. Now the highs were not getting significantly higher. You could see the highs were struggling as well. In fact, this is quite a consolidation pattern. This is quite a little bit of a pennant type formation. We'll talk about those in a future lesson. But after here, you can see that when the market failed to put in a new lower low, that once again was our first tip-off that prices are perhaps going to change direction. And that's what happened when they went up, made a new high, higher low, new high, and then we hit this period where prices are floundering a little bit. And that was through here. So then they come back down, make a new low and a lower high. Now once again, this lower high, the fact that this high is struggling and not able to reach this previous high, is our first indication that we are going to be looking to sell. And of course that's what happened. We got this big bar to the downside, and then we got this nice little leg moving down. Market made a low, didn't supersede the old low, but it did supersede this last low. Came back, showed us a lower high, so we know we're still in a downtrend, and therefore we can sell the next resistance that happens. Well, we had resistance happen here. Then it came back with support. Then the market came back with resistance again. Now remember, resistance is our green-red bar combination. So we should have been able to capitalize on this move lower, as well as this smaller move lower down here. Now, of course, where we are right now is the market has failed to make a lower low, and it has come back, made a new high and a higher low, a new high, and now we're back in this state of limbo. So it looks like we're going to be waiting for a confirmation of sorts to see whether the market's going to take out this old high or put in a new low. Now, how could we trade this? Well, we could trade this below this low right here in anticipation that the market is actually setting in a new downtrend. We can anticipate that it's going to put in a new high and hold this old high, and we do have resistance right now. We have our green-red bar combination. So there's absolutely nothing wrong with setting a sell order below here and taking advantage of a move lower. And guess where it's going to go? That's right, it's going to come right back down here and see if it can take out the old lows. And that's what happens time and again. Now just quickly, the other way that you can look at these markets is through moving average lines. Moving average lines are a very simple way to graphically look at the market trend. One of my favorite lines for determining moving averages is the 20-period moving average. Nothing fancy going on here. 20-period moving average shows us pretty much the monthly average price. This is just a simple 20-period. You can use an exponential if you prefer. It really does not matter. The idea is that so long as prices are above the 20, we're in an uptrend, and when they're below the 20, we're in a downtrend. And you can see it how closely the market did adhere to this principle, where through this entire region, from back here when the market first started making higher lows, we are in an uptrend. And then back up here where it topped out, look at the first failure. It put us in below the 20-period moving average, and therefore we're in a downtrend. Then you come back here, and now all of a sudden the market's above the 20. Remember, it was struggling all this time to get lower. It didn't happen. And now it's above the 20. We're in an uptrend. Below the 20, we're in a downtrend. And now we're back above the 20. The only danger with the moving average lines is you don't want to lose your perspective of what's happening to price. So try to remember that the moving average is just a tool, that it's not written in stone. For instance, back here, this consolidation period, you had to pay attention to the fact that the market was not putting in lower lows. And not just say, well, the market's below the 20, I'm going to sell. Now, there's nothing wrong with that. You can certainly limit yourself to one side of the trade, but by just taking a look at what the price action was doing and saying, okay, the market is having trouble going lower, that gives you a suggestion that the market is perhaps going to head higher. So Remember, if you choose to a moving average line, it is just a tool, but try to focus on what's happening on the price charts as well, and take your trades accordingly. And that's this week's Tricks of the Trade.